Good morning, I'm Clinton Griffiths. A new report shows while inflation persists, it is starting to moderate. The Labor Department releasing the latest consumer price index. It shows prices climbed 6.4% in January from a year earlier. While that's down slightly from the previous month, it's still higher than what economists expected. Ag Day's Michelle Rook joins us. And Michelle, what does this mean for future interest rate hikes and for farmers?
Clinton, annual inflation at 6.4% is down since the peak in June of 9.1%, which was the highest reading since 1981. However, with the CPI in January actually firming about 0.5% compared to 0.1% in December, it signals more interest rate hikes are coming. This comes just as farmers head for the fields to plant the 2023 crop. Now, the Fed uses the CPI, but also the Personal Consumption Expenditure, or PCE, to gauge inflation and determine the size and duration of the rate hikes. Both are indicating while the Fed may not be as aggressive as they were in 2022, they still have some work to do to get to their target of 2% inflation for the U.S. economy.
We're going to continue to see interest rate hikes, probably still the same variety, 25 basis point moves. I don't expect the U.S. Federal Reserve to come in full bore and go back up to 50 basis point moves anytime soon. I don't think it's that hot of an inflation market. But we're still seeing higher prices. And so we're still going to see interest rate hikes over the course of 2023. That's just the way it is.
That means it will cost much more to borrow money, especially for farmers buying land, equipment, and inputs to plant this year's crop. Ag finance experts say that means they need to be strategic with their operating notes and long-term debt financing.
Lines of credit are normally at a variable rate. Well, this year with the Fed still talking about other rate increases on the table, it probably makes sense to discuss a fixed rate. So a fixed rate on an operating line to take that risk off the table.
Ag finance experts are also recommending that if farmers have grain they can sell to generate some cash for some or all of their operating costs, that might be a better strategy than paying the high cost for borrowing money. Now, one key market indicator of higher interest rates ahead in 2023 is the yields on 10-year Treasury notes. They have bottomed and are starting to turn higher again at right around 3.78%.